Chairman. Chairman Powell, thank you. Thanks for the extra time so we get all these questions in. And just picking up where my colleague, Mr. Gottheimer, left off, talking about non-banks and banks and kind of the regulatory framework. Recently, you published online the list of master accounts that the Fed has. Are any of those master account holders non-FDIC insured entities?
Are any of them? I don't know.
Could you get that answer back to us, please?
Sure.
Okay, thanks. So when I think about some of the dynamics that are going on in the market related to banks, non-banks, securities, not securities, one agency in particular has been very activist in this place over at the SEC, and it's kind of tangentially related to the Fed, but crypto and digital assets in the U.S. has got a market cap of around $1.1 trillion right now. It's been there for a bit. Do you acknowledge that this asset class has staying power in the U.S. economy?
It appears to have some staying power. Of course, that $2.1 trillion was, what was that a year ago? A lot higher.
Yeah, it's had some volatility in large measure due to the lack of legal clarity, and so hopefully this committee will help that quite a lot here this summer with at least two bills, one on stable coins and one on market structure, and it'll be clear not just for Congress but for regulators, including Chairman Gensler, and obviously market participants, whether they're forming the ideas or investing in the ideas or participating in the activities in the space. But when I think about participating in activities, one of the core functions that has taken place for a while now is the reverse repo market. So it's hovered over just over $2 trillion for the first half of this year, and it follows kind of exponential growth that we've seen over the past few years. So what's your assessment on the implications that the reverse repo market has on our economy?
Not much. It's just a place where holds money on the Fed's balance sheet. It's like a mutual fund. I mean, in fact, it's as the Treasury has been issuing bills to refill the Treasury General account, we've actually seen the reverse repo overnight facility declining. So,
isn't there some sort of conflict with higher reserve requirements, liquidity, and lending in the market? Or is there any tension there?
I don't believe so. It's just a place where largely money market funds have been putting their money, and as rates normalize in the economy, we're likely to see the reverse repo facility shrink dramatically, and I think without particularly important macroeconomic effects.
If you think about the implications, the Fed had to intervene in September of 2019 to provide stability and liquidity to that market. The fact that the Fed needed to use an emergency facility to intervene in the market would normally indicate some cause for alarm. Do you feel like that was an aberration? There's no more cause? Everything's been settled?
Well, that was about suddenly finding ourselves in reserve scarcity. So we'd been monitoring the level of reserves really carefully and thinking that we knew where scarcity would start to appear. And the problem is demand can be very volatile. So demand spiked and there weren't enough reserves, so you had a situation where we had to supply reserves in big quantities. That's not what's going on with the reverse repo facility was at zero for a very long time. And I think it's shrinking now. We don't know how much it will shrink.
Well, I think the growth of it kind of highlights some of the related concerns for inflation and tension between liquidity and frankly, when you look at the requirements for capital and the alternative returns in the market, there's a concern. Well, all that capital can't be deployed in the same place. So when you have to pick places for it to be deployed, then it certainly has implications. So would love to follow up with you on it, maybe align my own views with the thinking at the Fed and with some market participants. When I think about the Federal Reserve, of course we think about monetary policy, and we want Fed autonomy on monetary policy to some extent. A lot of non-market intervention that to me continues to be a cause for concern. Continued purchases of mortgage-backed securities, for example, prevent real price discovery. Is Fed's purchasing propping up prices, or is it holding them artificially low? It's a non-market influence. and I think it has some distortions. So as chairman of Housing and Insurance, I am continue to be concerned about that. But the other thing is, really, the big concern is the regulatory side.
Gentleman's time's expired.
I yield.